Please come to mutual fund chapter again. We were discussing exchange traded funds. These are the mutual funds which are traded on stock exchange. They usually track a particular index. So they are like index fund, but they are traded on the stock exchange. So they have the benefit of index fund also, benefit of a stock also. Anytime you can buy or sell during the daytime by either placing an order with the broker or nowadays on your mobile phone also, on your laptop also. The market price of ETF is usually close to the NAV. ETFs are very popular for gold items also. Instead of buying gold, you can buy gold ETF, which will track the price of the gold. So there are 4 types of ETF products available in the market. There are 4 types of ETF products. In your book, it's written. The 2 most popular ones are index ETF, commodity ETF. So what index ETF will do? It will track index like Sensex, Nifty. Okay. So you may not buy index directly. You can't buy Sensex, you can't buy Nifty. Then other option is you can purchase the shares of Sensex and Nifty. That might cost you a lot. If you buy all 50 shares which is used for Nifty calculation, you may have to spend say 5 lakh rupees or 4 lakh rupees. But then simply you can purchase Nifty index ETF with some minimum 5-10,000 rupees also, and you enjoy the benefit of those shares. And plus these are traded on the stock exchange, so you can sell them anytime you want. So most ETFs are index fund. Most ETFs are index fund that hold securities and attempt to replicate the performance of the stock market index. So what is the rate of return you can expect from such ETF? What the market would normally give. So if you are investing in say Nifty market index ETF, Nifty has generated a return of 12% in a year. This ETF will generate around 12%. If the fund manager is more active, dynamic, efficient, he may generate more than 12%. But if the fund manager is not very active, passive, he thinks that I know these are the 30-50 shares I have to buy. This is the proportion in which I have to buy, just buy and relax. Then it might give you a lower return also than Nifty. Similarly, if you don't want to invest in commodity directly, don't want to buy gold, silver or other precious metal, okay, then you can invest in commodity ETFs. Commodity ETFs invest in commodities such as precious metals and future. So as the value of the commodity will go up, the price of commodity ETF also goes up. The third type of ETF is bond ETF. So if exchange traded funds that invest in bonds are called bond ETFs. Instead of you investing in bond directly, you invest in bond ETF. They will invest in bonds. Right? So these are like bond fund but traded on the stock exchange. They thrive during economic recession because investors pull their money out of stock market and into the bonds. For example, government treasury bond or those issues by companies regarded as financially stable. What is the advantage of investing in a bond ETF? Stability, less volatility. Because if there is an economic crisis, stock market usually will fall, but bond prices will not fall. In fact, people will switch from equity to bond. Okay. Because of this cause and effect relationship, the performance of bond ETF may be indicative of broader economic conditions also. So how the bond ETF perform is an indicator of economy also. If bond ETF prices are going up, means stock prices are going down, because then people are shifting from stock to bond. And then there is a currency ETF. So instead of you investing in currency, you can purchase currency ETFs. Okay, the funds are total return products where the investor get access to foreign exchange, spot exchange, right, spot exchange, local institutional interest rate, and a collateral yield. You don't have to directly invest in currencies. ETF, they will invest in different currencies and they will generate return which is passed on to the investor. So automatically if they perform well, the value of the ETF will rise. So you can also invest in this. You have a bank account, start. You have money also. No. Why you don't get stipend? Stipend is not sufficient to bear your traveling expense also. Oh, no problem. Then you continue to read. Categorization and rationalization of mutual fund schemes. Now this is very important because there is a question for some 20 marks I am going to ask below this. And I will check whether you are aware or not, awake or not. In the recent times, many mutual fund schemes have come in the market with all varieties of name also. Okay, dream fund, vision fund, global fund, this fund, that fund. Now you are an investor, you are already a confused lot, you are already a confused person. On top of that, these so many names that appear in the market: blue chip fund, okay, high growth fund, low return, no, not low return, high return fund. You don't really know what is the feature of this fund. At least the name should give me some indication. Name should give me some indication. Reliance equity fund. Okay, so now I can understand this will go in Reliance. This is an equity fund launched by Reliance Mutual Fund. But some different types of name. Dream focused fund. Now what is dream focused fund? Do you understand anything from dream focused fund? So our SEBI, the boss, now they have said all mutual fund will standardize the schemes. These are the schemes and you have to name accordingly. You can't write all those fancy names, Tiger Fund, okay? And you have to explain below this fund stand for this purpose. So that everybody, all mutual fund houses now will have to use a rationalized mutual fund scheme names. Otherwise it was creating a lot of confusion. Even I was confused many times what this scheme is all about. Dynamic fund. What is dynamic? Everything is dynamic. How do I understand whether it will go in equity or bond or balanced fund or arbitrage they are using, derivative they are using? We are not sure. Money market. Now, dynamic fund does not clarify what exactly they are going to do. Okay. So now very important they have done, useful for you also. And in the exam immediately they have asked a question on this, which I am going to take just below this. So that is called categorization and rationalization of mutual fund scheme. The idea is standardization, reducing confusion, okay, and let the investor understand the product better so that he can take a more informed decision, aware decision. He is not misguided by these fancy names. So it is desirable that different schemes launched by mutual funds are clearly distinct in terms of asset allocation and investment strategy. By referring the name, one should be able to get a very clear idea where my funds will be allocated, in what proportion it will be allocated, and what is the strategy of the fund manager. Okay. Of course, he can read the offer letter in detail, prospectus in detail, but not everybody initially has that kind of idea that I will read the prospectus. First, he will read the name, then he will decide. Okay. Further, there is a need to bring in uniformity in the characteristics of similar type of schemes launched by different mutual fund. One more point I need to tell you, these mutual funds always wanted to come out with a new product. If you launch the same scheme, after some time it becomes little boring. You are not able to get new investors. So what they were doing? Repackaging the old wine in the new bottle with some minor change in the scheme. So first they will bring top 200 fund, means investment in the best 200 company. Then after some time top 150 fund. Array, what is this? This 150 fund is a subset of 200 only. Top 100 fund, same mutual fund house. SEBI says no. All this you have to merge into one scheme now. Is it right? So that is the second line, to bring in uniformity in the characteristics of similar type of schemes launched by different mutual fund. Now you just can't fool the investor by just changing the name or changing one or two feature and again you market it as if it is a new scheme. This would ensure that the investor of the mutual fund is able to evaluate the different options available before taking an informed decision to invest in a scheme. So to my understanding, this is really a very good effort by SEBI, because these mutual funds were a source of confusion rather than a source of investment. And as you know, when people are confused, remain away from that scheme. Is it right? Whenever I ask people, why don't you invest in mutual fund? Simple answer, we don't understand. Hence we don't invest. It's our money. It's our money. So I will not invest my money in a product which I don't understand. And if you further confuse him with all different types of names, he will get more disoriented from the mutual fund. Okay. Newspaper for you. Are you read? You had asked one question. Now, next paragraph in your book. In order to bring the desired uniformity in the practice across mutual funds and to standardize the scheme, categories and characteristics of each category, the issue was discussed in the Mutual Fund Advisory Committee. So now after a lot of debate, discussion, committee meetings, they have come out with the following list. And now every mutual fund house has to fit whatever scheme they have launched into these 5 categories only. How many categories? 5 categories of scheme, scheme characteristics and type of scheme. And on that there was a question in the exam. They have given the scheme, you have to fit into one of these 5. Okay. So uniform description of scheme now they have started. To avoid confusion, simplify, make investor take informed decision, do not make him run away from the market, bring him into the market. So what are the schemes? The schemes would be broadly classified into following groups, 5 groups. So your mutual fund scheme now can be only one of these 5. Equity scheme, we'll discuss detail, debt scheme, hybrid scheme, solution oriented scheme and other schemes. So other scheme is still, it is an open ended area where people can fit something. Okay, other schemes. Before we go further, first just I want to read the definition of large cap, mid cap and small cap fund, because many fund houses have this scheme. Reliance mid cap fund, Reliance mid cap and small cap fund, Reliance large cap fund. So these mutual fund houses again, they bring a lot of schemes which have the name mid cap, small cap, large cap in that. What is large cap? What is mid cap? What is small cap? There must be some criteria. So now they have defined the large cap, mid cap and small cap. And what is a large cap? Very simple. The top 100 companies of the country in terms of full market capitalization is large cap. That means, what is market capitalization? Number of equity share into market price. Full market capitalization means all the shares issued by the company, promoter and non-promoter. Only if I say free float market capitalization, then it would mean only the non-promoter holding, free float. But full means both. So who will calculate this list? This responsibility is given to MV. This responsibility is given to MV. Periodically this MV will sit down, okay, check on this date which are the top 100 companies, and they will be called large cap for the purpose of mutual fund industry, and then the mutual fund will have to call them large cap fund, these 100 companies. Next 150 companies from 101 to 250 in terms of full market capitalization will be called mid cap fund, and then those remaining companies listed on the stock exchange from 250 first and above, small cap funds. Is it right? Earlier the benchmark was market capitalization. If your market capitalization is above say 1 lakh crore, you are a large cap fund. Between 5,000 to some lakh crore, you are mid cap fund. But now that they have removed. Now it is all companies will be in a list, the top 100 large cap, next 150 mid cap, and all remaining will be treated as small cap funds. Okay. Mutual funds will be required to adopt the list of stock prepared by MF. In this regard, an MF would adhere to the following points while preparing the list. So who has been given this responsibility of preparing this list periodically? MF. And accordingly the mutual fund house will have to adjust their shareholding. If they say large cap fund, but that company has now moved into small cap, they will have to reshuffle. Remove that stock. If the name of the scheme is large cap fund, but that company has now moved into small cap category. If the stock is listed in more than one stock exchange, an average of the full market capitalization of the stock on all such stock exchanges will be computed. So if the stock is listed on BSE also, NSE also, an average market capitalization will be taken. Okay. So sometimes there is a price variation of 1 or 2 rupees. Then the problem will arise whether I should take NSE price or I should take BSE. Take average. In case a stock is listed on only one stock exchange, the full market capitalization of that stock on such an exchange will be considered. Okay. So that is simple. If it is listed only on one stock exchange, take that. The list would be uploaded on the MF website. What is AMFI? Association of Mutual Fund in India. And the same would be updated every 6 months based on the data as on the end of June and December of each year. So every 6 months they are going to update that list. And then again for next 6 months, mutual fund will have to follow this list. They can't change it every day. It's not practically possible. So 6 months will be the time span. The data shall be available on the MF website within 5 days, 5 calendar days from the end of the 6 months period. So the moment 30th June gets over, by 5th of July, they have to upload the revised list, because it is possible there can be shifting of companies from small cap to mid cap to large cap to mid cap to small also. No, why October? June and December. So 30th June is over, by 5th July they will upload the list. 31st December is over, by 5th January they will upload the list. And based on this list, the classification will be done, because this is a very gray area, small cap, mid cap. Okay. Small cap are small companies as the name suggests, but the risk is very high for such companies. The risk is very high. Let the investor be very clear that I am investing in a very risky company or a less risky company as far as large, mid and small cap are considered. So subsequent to any updation in the list, now what will happen if the MFI updates the list? Mutual fund will have to rebalance their portfolio if required. A large cap company has moved into mid cap and your scheme is large cap fund or say mid cap fund. Accordingly, that stock will have to be included or excluded in line with the updated list within a period of 1 month. So within 1 month, you have to rebalance your portfolio. What is rebalance? Buy some, sell some. Is it right? That is, we have learnt in your SFM, rebalancing of portfolio. You sell some, you buy some. Now, in SEBI, this what you have learnt is a part of SEBI circular only. Okay, this paragraph which you learnt is SEBI circular. In that SEBI circular, there is an annexure. In that annexure, they have given 5 types of schemes. Which 5 types we have discussed just now? Equity scheme, debt scheme, hybrid scheme, solution oriented scheme, other scheme. And within equity, you can now have only 4 categories. You can have 4 categories. And within this 4 category, you have to fit them. Is it right? So while naming some kind of scheme, you have to ensure that it fits into one of the 5. Within 5 subcategories they have mentioned. So if you call it large and mid cap fund, you can call it large and mid cap fund. So if you have the following characteristics, only then you can call it large and mid cap fund. Otherwise, no. Otherwise, you will be misguiding. Minimum investment in equity and equity related instrument of large cap company will be 35% of the total asset. Minimum investment in equity and equity related instrument of mid cap stock will be 35% of the total asset. So if you are calling it large and mid cap fund, name is large and mid cap, at least 35% should be in large cap company and at least 35% should be in mid cap company. So 35, 35, 70. Remaining 30 you can keep in cash or debt, because you need to have some liquidity also. No? You can't put 100% in equity. If somebody gives the redemption request on a day when the market has crashed, you will also crash. So they keep some 10-20% in some liquid securities, which is allowed. But 70% in this example will go in large and mid cap. 35 minimum. More than that is also welcome. The remaining 30% can they invest in small cap? That is where the CS intelligence lies. They will find some or the other loophole. They don't look at the substance. When you're calling it large and mid cap fund, means you have to invest in only these 2 categories. Remaining will be for liquid assets. Okay. Means this scheme is not going to invest in small cap fund. Na? What is the name? Large and mid cap fund. So remaining 30% normally, see, you are a fund manager. You are not going to invest remaining in small cap. You are taking too much of a risk. Okay, maybe you have to invest that 30%, 5-10% they keep cash in bank, because they may receive the redemption request. 5-10% they keep in very liquid asset like money market instrument, so that if somebody gives a huge redemption request, they can use that also. This is minimum I am saying. So it can be more than 70 also, na, total. Minimum 35, 35. So 70 has to go into these 2. 30 will be on other asset, but it won't be small cap. Otherwise, you are misinterpreting the intention. If you want to invest in small cap fund, then name it as such, small cap fund. Minimum investment, wait, this line I have not read. And now the mutual fund is, companies will have to write like this, large and mid cap fund, and in bracket they have to write, to explain to the investor, an open-ended equity scheme investing in both large cap and mid cap stock. So now when you read the name of a scheme, you will find it is written where your money is being invested or what is the strategy. Suppose you name it as a small cap fund, equity and small cap fund, then minimum investment in equity and equity related instrument will be 65% in small cap companies. 65. Now here it was 35 because there are two, it is 65. Okay. Then your question, can I invest remaining 35% in large cap, mid cap? No, idea is that it's designed for small cap companies only. Okay. So you have to write, as I said you, nobody is going to invest 100% in the shares. They have to keep some cash and bank balance. No? If tomorrow you receive a huge redemption request from some big investor and tomorrow the market crashes, you will have to sell first your share and redeem him. But that will be a huge loss. So then it is not a good fund management. What about closed-ended? They also will have to follow the similar, only you have to change the name here. Small cap fund, then you will write a closed-ended scheme. Okay, if it is a closed-ended scheme. If it is an open-ended scheme, you have to write open-ended scheme. An open-ended equity scheme predominantly investing in small cap stocks. I will just check, can I invest in other cap? They have not explained in the note, so I cannot comment. And whatever R&D I have done on this point, there is nobody who is going to clarify me right now, can they invest remaining in large cap fund? My logic says ethically it should not be done, because your whole idea is to tell the investor we are going to park your money in small cap fund, and that is minimum 65. Out of remaining 35, you should keep 10-20% in liquid asset or cash, so that you can handle the redemption request. Some amount you keep because if you get a good opportunity, you can purchase it at a lower price also. Okay. This is how you should do the fund management. Keep some additional cash in hand so that if you get some bargain purchase, lower discount, some share at a lower price on the given day, you can purchase it. Okay. Then next line is dividend yield fund. So if the mutual fund is investing predominantly in dividend yielding stock, then it is called dividend yield fund, and the minimum investment in equity will be 65% of total asset. So if you want to call it as a dividend yield fund, then you should invest in companies which have high dividend yield, and the minimum investment in equity share of such company would be 65%. And what name you have to write after the name of the scheme, whatever is that, it's an open-ended equity scheme predominantly investing in dividend yielding stock. And then focused fund. Focused fund, that means you are going to invest only in certain category, certain sector, or some common attribute. Like as I said, you may invest in the nifty stocks. So in this case, the SEBI says, if it is a very focused fund, a scheme focused on number of stock, where the maximum number of share you can purchase is only 30. Companies, of course. Maximum number of shares of different companies will be 30 stocks should be there. When I am saying stock, it means one company, not more than that. Because then what is the point in focus if you invest in 200 companies? Then where is the focus? Then you name it large cap and mid cap or small cap. Okay. Minimum investment will be in equity 65% of the total asset. Like for example, now you can have index funds where you will invest in 30 share of Sensex or 30 share of Nifty. Okay. Or you can have say pharma fund where you will invest in at the most 30 stocks of pharma companies. So that is a focus fund. Now next is, how will you write the description of such scheme? You will write like this: an open-ended equity scheme investing in maximum 30 stock. So the investor will know that your money will go into these 30 stocks. Mention where the scheme intends to focus, where you want to invest. So you can invest in multi-cap. Multi-cap means all types of cap, large, small, mid. Or you can just focus on large cap, just focus on mid cap, or just focus on small cap. But in that case, the number of stock you will be holding is not more than 30. Is it right? So in the market nowadays, you will find many mid cap stock fund or multi cap fund, which means they are investing in 30 companies in different categories. Now, if you want to launch a debt scheme, here also we had a lot of varieties. Debt fund, again source of confusion. Now they have reduced it to 3 categories. So you have to call it ultra short duration fund, low duration fund, or money market fund. Now what is ultra short duration fund? Ultra short means very short. So investment in debt and money market instrument. If you want to call your scheme as ultra short duration fund, you have to invest in debt and money market instrument such that the Macaulay duration of the portfolio is just between 3 months to 6 months. Now, what is Macaulay duration? Duration you have learned in bond valuation. Do you remember? I don't think so. Some student looked at me as if they heard it for the first time. Refer bond valuation chapter. Duration is the weighted average time taken by an investor to recover his investment. Is it right? And how it is calculated? I don't remember. You remember? Sum of present value into weight divided by sum of the present value. So you will multiply year 1, 2, 3 by the present value of cash flow. Take the total of the year into present value, third column, divide by the total of present value column, and that gives you duration. It was discovered by one gentleman called Frederick Macaulay, and after his name it is called duration. So duration helps you to basically understand the interest rate sensitivity of a bond. What is the purpose of calculating duration? Interest rate sensitivity of a bond. Higher the duration, higher the interest rate sensitivity. This was PV. Higher the duration, higher the interest rate sensitivity, lower the duration, lower the interest rate sensitivity. Interest rate sensitivity means if suppose duration is say 6, market rate of interest changes by 1%, the price of the bond would change by approximately 6%, not exactly 6, because again there is a further calculation called modified duration. From duration you get modified duration, and then you can say approximately the change in the price will be equal to modified duration. Higher the duration, higher the change in the price of a bond for a given change in market rate of interest. So if you are calling it ultra short duration fund, it means its duration should be ultra short only. That means 3 to 6 months. It is 3 to 6 months. You don't have to calculate. Institute will give you. Institute will mention in the problem that the duration of this debt or bond fund is 3 months. So then you have to put it under ultra short duration fund only, or they mention between 6 to 12 months, then low duration fund. Okay, and then the mutual fund house will have to write this description also: an open-ended ultra short-term debt fund investing in instrument with Macaulay duration between 3 months to 6 months. Low duration fund, same thing, only here the duration will change from 3 to 6 to 6 to 12 months. And then you have to write a similar note: an open-ended low duration debt scheme investing in instrument with Macaulay duration between 6 to 12 months. And then the third debt scheme can be money market fund. So here you have to invest in money market instrument having a maturity up to 1 year. You can't invest in investments with maturity of more than 1 year. And you have to write the description: an open-ended debt scheme investing in money market instrument. So by reading this, the investor will get to know where the company is going to invest. Then third is hybrid scheme. Hybrid means they invest in multiple asset classes. So what we used to call balanced fund earlier, balanced fund, which you learned earlier, now they will be mostly called hybrid schemes. So here there will be two category: dynamic asset allocation fund or balanced advantage fund. So you can either call it dynamic asset allocation fund, means they can invest in equity also, bond also. So they will keep switching from equity to bond. Or balanced advantage fund means balance of equity and debt, so that you get the better of both the world. So here the scheme characteristic will be investment in equity or debt that is managed dynamically. That means they can keep switching from equity to bond and bond to equity. And what narration you have to write: an open-ended dynamic asset allocation fund. Let the investor know that your money can be moved from equity to debt or debt to equity. And then the next hybrid scheme, you can call it arbitrage fund. Scheme following arbitrage strategy means investing in multiple categories of asset classes. They will invest in equity, debt, future option also. Minimum investment in equity and equity related instrument will be 65% of the total asset. So you can invest up to minimum 65% will be in equity or equity related instrument. And you have to give this narration to the investor that it is an open-ended scheme investing in arbitrage opportunities. You can see these are average duration. No? Some see it's an average. No? Some bonds will have a duration of say 1 month. Some will have a duration of 5 years. So the average will come to only long term. They will not invest, no? Because they may need the funds urgently also. So the maturity period should be of different types, so that if they need funds, they can sell it also. Okay. Otherwise, you can use that balanced fund. There you can invest in balanced fund. If you want to invest in a long term, then balanced fund. But I will check this again. Some queries you have raised are interesting queries. But these are the options which right now the SEBI has given. Her question is why there is no long term debt or long duration, maybe 2 to 5 years duration. So that question mark. We'll come to others, wait. But you can put in this one, no? Dynamic asset allocation fund. So there you can invest in any date. There is no restriction here. Next is solution oriented scheme. Now here they have given two examples, I think, because there can be different schemes under that. So if the scheme is trying to provide a solution to some issue, then you will call it solution oriented scheme. For example, retirement fund. A retirement fund scheme having a lock-in for at least 5 years or till retirement age, whichever is earlier. So some people may want to save for their retirement, and there is a scheme which says you invest in us, the minimum lock-in will be 5 years, or you retire, whichever is earlier. So in that case, the description will be an open-ended retirement solution oriented scheme having a lock-in for 5 years or till retirement age, whichever is earlier. So by reading the description, the investor will know that this scheme will have a lock-in of 5 years or you retire, whichever is earlier, and it is basically helping you to meet with your retirement solution. On retirement, you will get a huge amount. Some people may invest for their children. Children's fund. Scheme having a lock-in for at least 5 years or till the child attains the age of maturity, whichever is earlier. Suppose he would go to Stanford University at the age of 18. So you want to save for him. So you can choose this children fund and it will have a lock-in of 5 years. Or if the child attains the age of 18, whichever is earlier. Okay. So such schemes are also there. Basically the intention is that you set aside some money so that when the children will require that money for future education or whatever, you can have a huge amount of money at that time. So retirement fund, children fund, they are providing you solution. They are providing you solution like on retirement, what will you get? If your children needs funds for higher education, this fund will help you. And then you write the description similar to this only. That an open-ended fund for retirement for children having a lock-in for at least 5 years or till the child attains the age of maturity, whichever is earlier. Is it understandable? Now next is other schemes. Other schemes means here we have two, index fund or ETFs and fund of funds, that is overseas or domestic. So if it is an index fund or ETF, then the scheme characteristic will be like this: minimum investment in securities of a particular index which is being replicated or tracked should be 95% of the total asset. How much? 95. So if you are saying that it is a Nifty based ETF, then 95% of your funds will be invested in the shares of Nifty. And you have to write a narration, an open-ended scheme replicating or tracking a particular index. Fund of funds, overseas or domestic, minimum investment in the underlying fund should be 95% of the total asset. What is a fund of fund scheme? A mutual fund investing in another mutual fund. So here 95% you have to invest in other funds. An open-ended fund of fund scheme investing in fund. Little confusing. Fund of fund scheme investing in fund. Open book exam. Keep the book open. I will read a case study and then the student has to tell me whether it will go into equity, debt, hybrid, focused, okay, solution, other scheme, etc. Ready for the show? Let us see how many of you can give me the right answer. Recently, SEBI has come out with a circular relating to categorization and rationalization of mutual fund schemes. Okay. Description of some of the existing schemes is given below. Now, at the end of this question, there is a line which says, as per this circular, the existing type of scheme would be replaced with type of scheme as applicable to each category of scheme. So mutual fund have to now rename the schemes now after this SEBI circular. You are required to suggest the group in which each of the 5 existing schemes shall be recategorized with brief reason in the following format. So there are 5 schemes they have mentioned. Lot of details are given, and in the exam that asks this question, you have to give the answer in this format. Don't write, it's printed. Source means exhibit number. There are 5 exhibits, 1, 2, 3, 4, 5. Name of the scheme which is printed in the question only. Like for example, the first one, Dream Venue, Focused, 25 Fund Regular Plan. You can't understand much from this. So you have to write what is the scheme, whether it is equity scheme, debt scheme, hybrid scheme, solution oriented or other. And then here you write the category of the scheme. Okay, name of that scheme or category and reason for such recategorization. Okay, now this is an open book exam. You will not get the answers in any book. Only if you have studied, then you will be able to answer. Okay, same answer will not be there in any other printed material. It's a new question. Recently, SEBI that we have discussed. So now you see the story of this first one. Some hint will be there in the notes. Dream Venue, Focused. Underline the word focused. That means you have learned today equity has 4 types of schemes allowed: large and mid cap, small cap, dividend yield fund and focused fund. So in that case, from the name at least some idea you got that this will be the focused fund and it will fall under equity. But then read the whole story. Regular plan, a newbie in trend, Dream Venue Focus 25 fund. And this why this 25 they have written? Because probably they want to invest only in 25 shares. In focused fund also we have seen you can't invest in more than 30 shares. Has nevertheless managed an impressive show for the last 3 years. Strong outperformance of the benchmark. And category has allowed it to debut in the rating scale with a 4-star rating in 2016 and climbed to 5-star rating recently. Following the buy right, sit tight philosophy of this fund house. What is the philosophy? Buy right, sit tight. Have you heard? It means take some time and choose the right stock. But once you choose it, then you hold it for a long time. Sit tight. Hold it. Sit on it. Okay, don't keep shuffling. So that is called buy right, sit tight. Some of these brokerages houses have coined such terms, okay, just to market their product. Buy right, sit tight philosophy of this fund. Now the fund aims to own compact portfolio of quality stock, that is buy right, quality stock, and sit tight means secular long-term growth prospect with low portfolio churn, that is sit tight. Do not sell it too often. The fund prefers to restrict its holding to not more than 30 companies. So now the student will get the idea. This is a hint that this is a focused fund. It presently has 19 stocks in its portfolio. Furthermore, the fund has minimum investment in equity and equity related instrument up to 65%. So all those characteristics of focused fund they have satisfied. Not more than 30 share, minimum investment in equities 65%. While it seldom takes cash calls, it has a slightly higher preference for mid-cap stocks with peers in this category. In the last 1 year, its large cap allocation has hovered at 80 to 90%, while mid caps have been around 10 to 20%. That means it can't come under that first one called a large and mid cap fund, because if you want to call it as a large and mid cap fund, then minimum 35% should be in large cap and minimum 35% should be in mid cap. So this sentence will not help us to categorize it under large and mid cap. Okay. The fund's track record is yet too limited to draw conclusion about the performance. For 1 year, the returns are a good 5 percentage point more than the benchmark return and 3 percentage point more than the category return. On a 3-year basis, the margins are 8 and 5 percentage point respectively. So they are giving you the performance. However, the fund is yet to encounter hostile market like 2008 or even 2011 and hence its ability to manage choppy or falling market is yet untested. This paragraph is useless for determining the category. Performance will not help us in determining the category. It is only the investment made will help us to determine the category. A fund worth watching is in the large cap space. So this paragraph they have taken from some maybe newspaper article or some research report, okay, on mutual fund, which funds are doing how. There are people who publish their reports. ICI copy pasted, but what the ICI did, they said you have to now put it as per the SEBI's new rules. So first to tell me whether it will fall in equity, debt, hybrid, solution oriented or other scheme. Equity, because 80-90% you have invested in large cap fund. Once you decide equity, then the next is whether it will be large and mid cap, small cap, dividend yield fund and focused fund. So then focused fund, and then you can write the name of the company, Dream Focused Fund. Normally most of the mutual funds names are written like this. First the name of that mutual fund, so that I should know now who has come out with the scheme. Where should I approach? So it is always Reliance Equity Fund. Earlier it used to be Reliance Growth Fund, HDFC Arbitrage Fund, HDFC Top 200 Fund. So now name of the mutual fund scheme is Dream and it is an equity focused fund. Okay. And then you have to write the description, which they have not written, but reason for such reclassification. So you will write in the exam, it is a scheme which is focused. It's holding to not more than 30 companies. Condition number 1 is satisfied. And second, it has investment in equity and equity related instrument up to 65%. This is an exam question. Or why you don't want to write? No, you have to write Dream. This is how the mutual fund name their schemes. You can do the search. You can write focus fund. You take a chance. Next batch I will be able to give a more accurate answer. Okay. I am not going to appear again. No, sorry. No, even if you give me double CA, triple CA, I won't appear in C exam again. If you can take my entire blood, I will also not appear. If you threaten me with a gun also, I will not appear. If you give me an incentive of 10 crore rupees also, then also I will not appear. You were a ranker in that exam. That time exams were easy. Please don't terrify me. Come to point number 2. The open-ended. Now the Description is name of the scheme which was there earlier. Dream Venue. Ultra short term bond fund, regular plan. This was the earlier name. So name of the company is some Dream or Dream Venue, it seems. But then you read and then tell me in debt category, where will you put it? It seems like it is a bond fund. The open-ended ultra short scheme seeks to generate optimal returns. Institute will give you some hint if you are careful. Ultra short term means there is a scheme like that, but be careful while coming to a conclusion. Consistently with moderate level of risk and liquidity by investing in debt security and money market security, that the Macaulay duration is between 6 to 12 months. But this ultra short requires a Macaulay duration of 3 to 6 months. This says the duration is 6 to 12 months. The scheme seeks to generate optimal returns consistent with moderate level of risk, okay, and liquidity by investing in debt security and money market instrument. So one of the conditions is to invest in debt and money market instrument, that we have satisfied. Second condition was Macaulay duration should be 3 to 6 months to be called ultra short duration fund, and 6 to 12 months to be called low duration fund. So going by the nature of the scheme, it should fall under low duration fund. Okay. So now this is the old name. Scheme will be debt category. So institute view is that it will be called Dream Ultra Short Duration Fund. Why? It is an open-ended ultra short scheme, seeks to generate optimal returns consistent with the moderate level of risk and liquidity by investing in debt security and money market securities such that the Macaulay duration of the portfolio is between 6 to 12 months. However, in order to get itself recategorized as per SEBI circular, Macaulay duration of the portfolio shall be between 3 to 6 months. So institute has given both answers actually. What you do, you change it and you make it Dream Low Duration Fund. And then this line you underline. In case if you want to be known as ultra short duration fund, then you have to reduce the duration of the portfolio between 3 to 6 months. Is it right? So I think the institute answer needs to be revised. This is as per the institute suggested answer. Then there is one more. Dream Venue. My God. Dynamic Equity Fund. So where was this word dynamic used? In hybrid. In hybrid under which one? First or second? First. So you get some hint here. Dream Venue Dynamic Equity Fund Regular Plan. And what is the scheme? The scheme seeks to generate long-term capital appreciation by investing in equity and equity-related instrument, including derivative as well as debt instrument. So the feature of this scheme is that it will invest in equity and equity-related instrument and debt. So that condition is satisfied. The basic purpose of the scheme is to invest in equity and debt that is managed dynamically. In other words, it is an open-ended dynamic asset allocation fund. They are giving you the answer or the question. This is the question, but in the question only, they were so kind enough to write dynamic asset allocation fund. Is it right? Search for the hint in the question. The investment objective is to generate long-term capital appreciation by investing in equity and equity-related instrument, including equity derivative, debt, money market instrument and units issued by REIT and INVIT, INVIT. They are called INVIT. What is REIT? That is also one scheme. Real estate, एक minute, let me just check. Real estate investment trust, and this is infrastructure investment trust. Real estate investment trust, infrastructure investment trust, and these are also specialized type of mutual fund schemes, okay, which is also there in this chapter towards the end. REIT is real estate investment trust, and this other one is infrastructure investment trust, that we'll discuss later. These are some new innovations in this field. However, there can be no assurance or guarantee that the investment objective of the scheme would be achieved. So this was their old name, Dream Venue Dynamic Equity Fund, regular plan. Now you will put it as hybrid scheme, and the name will be as one student said, don't write dream, so I have removed it, Dynamic Asset Allocation Fund or Balanced Advantage Fund. You can add dream also if you want. Reason, as it is already given in the exhibit, that the scheme seeks to generate long-term capital appreciation by investing in equity and equity-related instrument, including equity derivative as well as debt instrument. Further, the basic purpose of the scheme is to invest in equity and debt that is managed dynamically. In other words, it is an open-ended dynamic asset allocation fund. I think that line was printed in the note itself, question itself. Yes or no? See, your institute is so kind and unnecessarily you just keep blaming it. I don't blame. I only said I will not reappear again. Now there is one scheme called CFDHRSF. My God, unbelievable. Somebody can name a scheme like this also. CFDHRSF. Now let us look at the new retirement fund, underline. Again there is a hint, retirement fund, children fund, or they are the solution oriented schemes. They are the fourth category, solution oriented scheme, because their basic purpose is to provide a retirement solution. And this fund's equity plan, which comes with a 5-year lock-in period, underline. You have seen in solution oriented fund, the lock-in period is 5 years generally, or whatever is the purpose. If that is served earlier, then that period is similar to an ELSS fund. What is that? Equity linked saving scheme, but there is a lock-in of 3 years. Since ELSS with a lower lock-in period of 3 years is available, why go for a scheme with a higher lock-in period and also 1% exit load if redeemed before the age of 60? Ask Vinod Kumar, CEO of South Asia Capital. Such products are also costlier because of their small size, because not many people will opt for such schemes. Small schemes charge a higher expense ratio, except for ITU RBP. Other schemes have much smaller asset under management. FIPF's AUM, for instance, is just rupees 339 crore. My God, 339 crore, and what they have written? Just 339 crore. In mutual fund industry, this is not a very big number, because they manage funds of lakhs of crores of rupees. If not lakh, at least some thousands of crores of rupees. So it's always relative term. The expense ratio of this product will be higher than the national pension scheme, but cheaper than insurance products. The main advantage of mutual fund retirement product is that you don't have to buy an annuity, as in the case with the NPS or pension plan from insurance company. Instead, you can opt for a systematic withdrawal plan to meet your regular cash flow needs. Since a part of the withdrawal is your principal, it will be more tax efficient as well. The question is why we should invest in this retirement solution fund. Because the cost is less. Okay, tax efficiency is there. Also, while the NPS restricts your equity exposure to 50%, if you invest in national pension scheme, they will invest maximum 50% in equity. With mutual fund products such as the CFDH RSF, you can take 100% equity exposure. Good or bad? Good, because equity in the long run have generated a very high return. In the long run. And here you have to invest for minimum 5 years. That means your expected return will be much higher. I have done all understanding of the market and my analysis says equity is the best product. Out of all the assets available in the market, which is the best one? But ELSS is also an equity scheme. But you have to invest for a long term. Any equity or equity related product is the best, but you have to invest for a long term, means around 10 to 15 years. And if you compare in 10 to 15 years span, which asset class has given the highest return? In all examples you'll find across the globe, equity. Is it right? So good, because you're in any case 5 year your money is blocked. However, this product do not come with an additional rupees 50,000 deduction available in NPS. Oh, in NPS you get that 50,000 rupees deduction under section 80 CCD. Is the name of a section CCD? Or is it the name of a cafe? My God, how do they design such short form CCD? Mutual funds have been asked for extra tax benefit to be extended to their products, but whether or not this happens will be known only after the budget is presented. This they have taken from some newspaper cutting. Mutual fund pension products also offer greater liquidity compared with NPS or products from insurance company. This is a part of case study. They give you so much of unnecessary information that in the exam you don't know which sentence will be relevant to solve the next question. Is it right? It's a part of a case study asked in the exam for 50 marks. I have only cut and paste the relevant discussion for today. You can withdraw your accumulated corpus after the lock-in period of 3 to 5 years is over. You may have to, however, pay a small exit load if you want to withdraw your corpus but have not reached the retirement age of 58 to 60 depending on the product. Calculating the lock-in period also varies across the fund. For example, in case of HDFC RSF, Retirement Solution Fund. So from the name in the exam you can make a guesswork. It is a retirement solution fund. The lock-in for each installment is calculated from the date of investment. So the money you invest at the age of 59 can be withdrawn only at the age of 64. These are the features of this CFDH Retirement Solution Fund. And what is the answer? This will come under which category? Which scheme? Solution oriented scheme. And the name of the scheme you can write CFDH Retirement Solution Fund. Okay. Why? It is specifically given in the exhibit that it is a retirement fund. That means the answer is there in the question only. Further, it is mentioned that the main advantage of mutual fund retirement product is that you don't have to buy an annuity, as in the case with the NPS or pension plan from insurance company. Instead, you can opt for a systematic withdrawal plan. What is a systematic withdrawal plan? SWP. SWP. SIP is when you invest. SWP is when you withdraw. Reverse. You invest today and they will pay you over a period of time to meet your regular cash flow needs. Since a part of the withdrawal is your principal, it will be more tax efficient as well. And the last one quickly, a small note. ITU, Nifty Index Fund. Now, where will these index funds go? other schemes. Okay, other scheme, and you have to write the name properly. The principal investment objective of this scheme is to invest in stock of companies comprising S&P, CNX, Nifty, and endeavor to achieve return equivalent to Nifty by passive investment. The scheme is managed by replicating the index in the same weightage as in the S&P, CNX, Nifty index, with the intention of minimizing the performance difference between the scheme and the S&P, CNX, Nifty index in capital terms, subject to market liquidity, cost of trading, management expense, and other factors which may cause tracking error. What is tracking error? That means the fund can earn more or less than Nifty. That is tracking error. So they will track Nifty. They will continuously track the Nifty. These are the 30 stock. I will buy the same 30 stock or 50 stock. Then this is the proportion in the Nifty. I will also keep in the same proportion. But still sometime you may earn more or you may earn less. That is called tracking error. So even if you are tracking an index, exactly you are trying to copy that index, you may not achieve the same return. You can earn more also. You can earn less also. So that is called tracking error in mutual fund parlance. The scheme alters the scripts or weights as and when the same are altered in the S&P, CNX, Nifty index. Okay. So as the share in the index will change, the scheme will also change the share. As the weight of a share in the index will change, the scheme will also increase or decrease the proportion of that share in the fund. So what will you do? Now you will write that this scheme will fall under the scheme other scheme, and category of the scheme will be index fund or ETF. And the reason for such recategorization, the principal investment objective of the scheme is to invest in the stock of companies comprising S&P, CNX, Nifty index and endeavor to achieve return equivalent to Nifty by passive investment. The scheme is managed by replicating the index in the same weightage as in S&P, CNX, Nifty index with the intention of minimizing the performance difference between the scheme and the S&P, CNX, Nifty index in capital terms, subject to market liquidity, subject to cost of trading, management expense and other factors which may cause tracking error. Okay. So that was a long case study, actual case study. So you got a little feel of the exam now. What kind of question they can ask you. Open book exam will not really help you to answer such question because this question was not there in the ICI module. Okay. Even the SEBI circular was not there in the ICI module. But in the question they had mentioned the SEBI circular, that this is the SEBI circular, so that the student can refer it there only. Now, who are the key players in the MF industry? Key players, guess. First, to understand how the mutual fund is set up in India. Mutual fund is set up as a trust under Indian Trust Act. It is not a company under Companies Act 2013. The business is set up by the sponsor. Sponsor is like a promoter. Someone who takes the initial steps to start a business is sponsor. And the money which the mutual fund receives from the different investors, it is invested by a specialized entity called AMC, Asset Management Company. And to ensure that the interest of the investors are protected, the overall operations of the sponsor or AMC is monitored by the trustee. There are 5 principal constituents and 3 market intermediaries in the formation and functioning of mutual fund. So then your question will be, who are these 5 main constituents in a mutual fund? And who are the 3 intermediaries? So the 5 main constituents are sponsor, AMC, trustee, unit holder, and the mutual fund itself. Okay, and who are the 3 intermediaries? They are custodian, transfer agent, and depository. Custodian, transfer agent, and depository. Again, you have to study custodian, transfer agent, and depository for the 3rd or 4th time. Now the next question is, who is an sponsor? Who is an sponsor? So a company established under the Companies Act. Sponsor is a company which is established under the Companies Act. They take initial steps to form a mutual fund. So they are called sponsor. But this information was not enough in the module. So I have added some more lines from my side also on the screen. Right. Either there or in the notebook. Sponsor is the promoter of the mutual fund. Sponsor is the promoter of the mutual fund. He is like a promoter of a mutual fund. Then next line, write the sponsor brings in capital. Write properly. The sponsor brings in capital and creates mutual fund trust and sets up the AMC. So he will take the steps to form a mutual fund trust and form an AMC. The sponsor makes an application for the registration of the mutual fund. The sponsor makes an application for the registration of the mutual fund and contributes at least 40% of the net worth of the AMC. So what is the interest of sponsor? 40% of the net worth of AMC is held by sponsor. Every mutual fund needs a sponsor before it can commence operation. Yes or no? Every company needs a promoter. Who can become a sponsor? SEBI says sponsor should have a 5-year track record in the financial services. Sponsor should have a 5-year track record in the financial services business and should have made profit in at least 3 out of 5 years. And at least made profit in 3 out of 5 years. The sponsor could be a bank. Next line, sponsor could be a bank. Like in India, many banks have floated the mutual fund. HDFC, ICICI, Axis, okay, Kotak. Or it can be a corporate, Reliance Mutual Fund. Or it can be a financial institution, LIC Mutual Fund. They have experience in the field of finance for at least 5 years and they should be making profit in 3 years, at least 3 years out of 5. All 5 are welcome. Okay. So this is the feature of sponsor. Done? Write little fast. And lot of MCQs they are asking on mutual fund chapter. lot of MCQs. So each line you read carefully from this chapter. The questions are like this also. Sponsor contributes dash percentage of the equity of the AMC. And the option will be 10, 20, 30, 40. So you have to choose 40%. Okay. Whether the following statement is true or false. Mutual fund does not require a sponsor. False. Okay. Like this. And they give you 2 marks for such answers. Guaranteed marks. Now I'll come to AMC. The most important part of this mutual fund is AMC. Who is responsible for the success of mutual fund? AMC. They are the brains of the mutual fund. I call them. They are the brains of the mutual fund. They take decisions. Where to invest, when to invest, how much to invest. Okay. They design the schemes of the mutual fund. Who takes initiative in investment, designing a scheme, etc.? AMC. So first, an entity registered under the Companies Act. So he has to get it has to get itself registered with Companies Act to manage the money invested in mutual fund and to operate the schemes of the mutual fund as per the regulation. So that is the role of AMC. Management of funds on behalf of investor, keeping the regulations in mind. It carries the responsibility of investing and managing the investor's money. Professional money managers are appointed by the AMC. Like you are CA, you are a professional money manager. Okay, with some training you can become a chief investment officer in a mutual fund, and then you can invest thousands of crores of rupees. To take care of the investors, corporates are invested in profitable securities based on risk appetite of the investor and according to the mutual fund scheme. Now, where will they invest? That depends on nature of the scheme. Just now we have seen different scheme. If it is a large and mid cap scheme, you can't invest in small cap 80% of the money. But if it is small cap fund, 65% and above it should go in small cap, because that is the boundary that we have defined for them. Work within the overall scheme framework. Is it right? Because the investor accordingly invests. No? He is investing in debt fund. Okay. And you have invested in some equity scheme. So that is a misguidance. So therefore the fund manager has to be very careful. Okay. The AMC has 3 departments. You can also choose where you want to work. Fund management. Now here they normally appoint those who have got good experience in fund management, who can understand balance sheet, profit, cash flow very fast, take quick decisions. So normally I have seen they hire people from IIMs or top management institute, students who have specialized in finance, or they also hire the top ranker CAs also in this. Okay. So you can try. But many of the CAs are hired for sales and marketing. Sales and marketing here does not mean you have to move from door to door with a bag behind. You have a corporate client, 5 corporate clients are assigned to you, and you have to meet their treasury manager, their CFO, and you have to tell them that these are the products, these are the features. Okay, and you can convince them to purchase 100 crore, 200 crore, because some companies treasury have a lot of surplus money, and they also look for avenues to park their money. So generally they meet the top management, CFO team, treasury team, and promote their mutual funds. And then there is a third category, operations and accounting. So those who look after administrative and accounting work. So some of you can go to this department also. Which are the top 5 AMCs in the world? Not written in your note, only for general knowledge. This is the world list. BlackRock, and they are managing assets of 6288 US billion USD billion. My God, I don't know how much is that. Vanguard Group, United States, $5,100 billion. Charles Schwab Corporation, US, 3360. UBS is a Switzerland company, 3101, very big company. Why I have written this name? After you qualify, you can apply here. You can apply. It's not that they will outrightly reject you. But of course, you should be first merit, first rank, second rank, or ranker. And they pay you like anything. What your mind can imagine and multiply by 5. Okay. First imagine some number. You will say, okay, I'll get 20 lakh. But you might get 1 crore rupees if you're a good candidate. And they do hire people from India also. State Street Global Advisor, United States. There is a list in the Google. Okay, you can check that list. Only write the name. I am telling you because these are the places where you should apply after you qualify if you are interested in finance field. And since you have chosen this capital market, if you get selected, one of my friends got selected. He got private jet for traveling across the globe. Okay. He does not take normal flight. Why to go to airport, wait there as per their timing? Private jet is provided to him. If he has to attend a meeting in Hong Kong, okay. Even if it costs say 10 lakh rupees for that, it's okay. These companies don't mind 10 lakh. It is like you have taken a cup of coffee on the restaurant. That's it. And their offices are on Taj Hotel Taj. They book the one entire first floor or whatever floor, 42nd floor of the entire hotel only. That is their office where they operate. You don't know? No, they work in offices of big hotels. And in India, these are the mutual funds where you can apply after you qualify. ICICI Prudential Mutual Fund. Many of my students are working on this ICICI Prudential Mutual Fund or SDFC Mutual Fund. Then Aditya Birla Sun Life Mutual Fund, Reliance Mutual Fund, SBI, UTI, Kotak Mahindra, Franklin, DSP, BlackRock, Axis Mutual Fund. These are the top 10 mutual funds in India. These numbers keeps moving also. Sometimes SDFC reaches the top, sometimes Reliance reaches the top. So neck to neck fight among first 5. Okay. Trustees. Now come to the next person in this list. 5 constituents we have to learn. We have learned 2. Which 2? Sponsor and AMC. Trustee. What is the role of trustee? The trustee holds the property of the mutual fund in trust for the benefit of unit holders and looks into the legal requirement of operating and functioning of the mutual fund. So he is basically there to protect the interest of unit holder, to ensure that all compliances are carried out by the mutual fund. Mutual fund invests according to the scheme of the mutual fund. Complaints of the investors are redressed, taken care of. Okay, fund manager do not go beyond their scope of work. Yes, if you have to invest in debt fund, why will you invest in equity? All this they have to check. Okay. Trustees may be in the form of limited companies also in some situation. The trustees have the duty to monitor the actions of the AMC to ensure compliance with the SEBI regulation. Okay. So continuously they will monitor the AMC and see that the decision of the AMC are not against the interest of the unit holder. Otherwise, he will go and complain to the SEBI. Okay. Fourth constituent is unit holder. You, the person who actually puts his money in the scheme, and he gets a proportionate stake in that scheme through a document or a unit called unit only. Is it right? It is like a share in a company. It is like a share. But to avoid the confusion between the share and the unit, here we will call it unit, which is as good as share. You are a proportionate stake holder in the scheme. So if you are holding 1000 unit, fund has issued 10,000 unit, mathematically you are a 10% stakeholder in that scheme. 10% of the net asset of that scheme belongs to you. So that is unit holder. Anybody can become unit holder. He can be an individual, he can be an entity. And then the fifth constituent is the mutual fund itself, which is established under the Indian Trust Act to raise money through the sale of unit to the public for investing in the capital market. The funds are collected and passed on to the AMC, and the AMC will then invest. Mutual fund has to be registered with SEBI. Which mutual fund is not registered with SEBI? SUTI, Special Undertaking of Unit Trust of India, is not registered, but the other one, Unit Trust of India, the normal Unit Trust of India, is registered with SEBI. Okay. Now quickly we'll see market intermediaries. These people are required for smooth operation of the mutual fund. Okay, smooth. They are also important. Like for example, custodian, transfer agent and depository. First question to you, you have learned this. Who is a custodian? Custody. So his main task is to keep safe custody of the securities. Okay. Is he required to be registered with SEBI? Yes. A custodian is a person who has been granted a certificate of registration to conduct the business of custodial service under SEBI Custodian of Security Regulation 1996. On the screen, what does he do? Option 1, dance. Option 2, sing. Option 3, keeps the safe custody of the security of mutual fund. Third one, of course they will not give you sing and dance option. They will give you a similar option, but then you have to choose the right one. So custodial services include safeguarding client securities along with incidental services provided, maintenance of account of client securities, together with the collection of benefit rights accruing to client fall within the purview of custodial service. So basically, in simple terms, you will keep the safe custody of the securities. Still, there is a possibility that there can be some securities in physical form. And in case of mutual fund, there are many securities where they invest, where they may get the certificate instead of demat. Plus, they will also help the client in collection of dividend, interest, bonus, right, etc. Why does AMC need custodian? On the screen, why does AMC need custodian? Answer is written in your book. So that they can concentrate on their main task. What is their main task? Investment and management of money. It is as simple as that. If you manage your securities, your interest, dividend, you will not be able to concentrate on your main activity of investment. So therefore, they can take the help of custodian. And then who are the transfer agents? Transfer agent is a person who has been granted a certificate of registration to conduct the business of transfer agent under SEBI Registrar to an Issue Share Transfer Agent Regulation Act 1993. My God. Can you remember such definition? No. Don't worry, you don't have to remember. But he has to be registered with SEBI for carrying out this task. And what does he do? Now in mutual fund industry, the volume of daily transfer is very high. Do you know that? Some mutual funds like ICICI Prudential, every day lakhs of new unit holders join, lakhs of old unit holders redeem. So continuously, if it is an open-ended scheme, continuously there is an issue of new unit, redemption of old unit. Somebody has to keep a record of all this. Somebody has to update the record of unit holders. Yes or no? So nowadays this specialized agencies called transfer agents, they carry out all such tasks. Preparation of transfer documents and maintenance of updated investment record. They also record transfer of units between investors where depository does not function. So it's short, they keep all the record keeping related to unit holders. And then who is depository? As you know, they are basically there for keeping the securities in demat form. They keep the securities in demat form. So under the Depository Act 1996, a depository is a body corporate which carries out the transfer of units to the unit holder in dematerialized form and maintains a record thereof. Now mutual fund units are also maintained in demat form. You don't get any certificate for that. Is it right? So depository takes care of keeping all the demat related securities. Okay. So the summary of our discussion is, at the top there is a unit holder because he will invest money in the mutual fund. Then mutual fund is managed by asset management company and monitored by trustee. Sponsor is the person responsible for formation of a mutual fund. So 1, 2, 3, 4, 5 are constituents of mutual fund. Custodian, transfer agent and depository are intermediaries. Is it right? Now we will continue tomorrow.